Aloha, traders and or investors. You got it. It is Tuesday, January 17th, 2023. Got that simulated trading account open here. Paper money, right? Paper trading. What's been going on in this account? Yesterday, the stock market wasn't closed in observance of Martin Luther King Day. And boom, had another position close on the ES, selling those options. And again, it was a high risk, low reward, but nonetheless, your good buddy Brent pulled it off. We still got another high risk, low reward, brought in 17 cents. Now, when you're selling stock options, this would be 17 bucks, but not on all futures contracts, but on WTI crude oil /CL, it's times 1,000. You're working with 1,000 barrels of oil here. So I brought in 170 bucks. What am I risking? I'm risking, I forgot exactly, but it's probably around like closer to 100,000. So yeah, there's a lot of risk, in there. So it's you can paper trade it if you want. If you have low experience and you try this in your real account, I would say you probably have a gambling problem. And so this is going well, though. I saw one time it was like 40 bucks a profit. So basically I just need oil to stay not just below 100, but kind of significantly below 100 for the remainder of this contract period. Now, in case my buddy Rich is watching this, one time you asked me, Rich, what are my rules for trading? Now, overall, I sometimes I'm doing this in my real account, but Rich knows I mainly sell cash secured put options on stocks I want to own. So I got some different rules, but with this with paper trading, this crude oil contract, some of the rules would be selling an option that has no higher of a delta than 10, right? In this case, I can't remember what the delta was exactly. It was around 3 to 5, but right now it looks like the delta is 41. But you got to remember we're dealing with contract sizes of 1,000, so that's 41.16 divided by 1,000, right? So delta is maybe it moved up a little bit. Maybe it was at 3, it's at 4. But if delta remains under 10, right, if it starts moving up to 10, then this position's probably moving against me. So generally, I'm going to open these contracts up with a delta somewhere around 5 to 10. I feel most comfortable around 5. Why is that? Because that means there's a 5% chance, just quick and dirty math. Delta of 5 means there's about a 5% chance it might expire in the money. That means a 95% chance it should expire worthless. It's not an exact science. It is an art of trading. And so if my delta doubles or it's getting close to doubling, I'm going to look at taking some action of adjusting. Also, I'm looking at my buying power effect, right? Buying power effect is really, really easy right now. You see over here with this, woo, boy, doggies, that is not what I wanted. We see over here with this SPX, right? Buying power effect, $20,000, right? And buying power effect is pretty low. Actually, the buying power, I think, went down, has reduced since I originally opened this position. And I originally opened this position on the 11th of this year. And what else? Generally, I'm going to open these contracts up when there's somewhere between like 40 to 35 days left to expiration. You can go out a little further. You could do it a little later, but as a really as a general rule of thumb, right? 5 to 10 delta, 40 to 35 days till expiration, and closing out at 10 cents, right? So as soon as I open it up, now you can trade it a little more. You can, like, I could have I could have brought locked in that $40 and then resell it or whatever, but I've got a variety of things going on. And what else? Oh, on a up day, is when you'd be selling, right? Selling a call on an up day, right? And this is not a day. This is a 15-minute chart. Day is over here, right? Moving up, that'd be a time to sell calls, right? Moving down, that'd be a time to sell puts. Kind of want to sell out there. When I learned this strategy, I learned it not so much using charts, a little bit using charts, but it's a lot more of just like using I guess the Greeks and this other mathematical type of stuff. But I'm definitely a chart connoisseur. So I also look for like support, resistance. So I got that $100. Right, in the last 6 months, it made it up there, but we see it's been going down over the last 6 months, and I think in the next, I think it's highly likely. Come on, select. I think it's highly likely that this, I'll be able to close this out at a profit. That's my guess. And I've been learning a lot more about the ES, the multiplier, right? The multiplier for stocks is 100. The multiplier for WTI crude oil is 1,000. The multiplier, it shows it right here, right? Probably, maybe even shows it in there. Boom, 100. The multiplier for the ES futures contract is 50. So that's the that's the benefit of paper trading. You start learning these little things and get them dialed in. And sometimes something that sounds really good in theory and it seems like it makes sense in your head, and you start paper trading it for a while and you're like, you know what, this really isn't as exciting, or there's some BS that I have to deal with. So paper trade stuff to figure that out. These still watching this Apple. Apple has we got a 150 strike price sold with 17 days left. And let's take a look at Apple. As I've been saying on these videos, if it starts right now, right, we see that it's seems to be breaking through this range of 130 to 135. But let's see what happens with the rest of the week. Today's Tuesday. Let's see what happens with the rest of the week. If it starts testing this 140, kind of like, if it looks like it's gonna get through here, there's definitely some resistance at this 140. If it starts getting through this resistance and it's like, well, first of all, if it starts having 135 become support, that will give it some, it'll be easier for it to get up through 140. But if tomorrow, if we see it sell off and it's kind of back down here below 135, right, then we got a different story. But if that happens, it's like staying below 150 is even easier. What I'm talking about right now is, what if I have to make an adjustment? Now there's more than one way to adjust, right? You could roll it. You could turn it into a credit spread. But what I'm practicing, because what I like the most is I like at the end of the month, or at least at the end of the quarter, I like owning more income producing stocks than I did previously. Why? Because I got this thing that when I'm 46, when I'm 80, I want to have a portfolio of dividend producing stocks. So if my cognitive powers are not as strong as they are right now, and it's likely that could be by the time I'm 80, maybe what about time I'm 70? I don't know. So I want to be. So my point is that I kind of would prefer to adjust this position by turning it into a covered call versus a naked call. Right now it's a naked call. So if it starts moving up and I see it catching some support here at 35, and then it starts doing this, right? And then the new support becomes 40, then maybe I'm going to consider buying stock. But because of this chart of Apple, I see there's also kind of resistance at, it's basically every $5 there's a little bit of resistance, right? So we'll see. We'll see. I'm monitoring. I'm waiting to see what happens. Look what's going on with the volume, right? The volume is low. So it's been moving up on this, how do I have this set up right now? Okay, this line here is basically a moving average, 50-day moving average of volume. So this line is showing us the average volume. You can see sometimes it spikes up. Right now, it's been 1, 2, 3, 4, 5, 6, right? Out of 7 trading days, 6 out of 7 trading days, it's not even meeting, it's kind of not even getting close to average volume. But it's still moving up. But when I see the volume like this, now if we see volume, you see a lot of red, right? It's been going down the last year. But let's forget about the color or pretend the red is green. If you see volume like this and it's green, it's probably going to go up. It still could go up. I'm not saying it's not, but this lack of volume here is making me watch it even more. And I'm thinking, like, look at this candle. This candle compared to this one. Hold on one second. All right, as I was saying, look at this big candle up here, right? Look at the length of this candle. Look at the length of this candle. Look at the length of this one. Right, that one, you got more of this wick to the upside, which means it traded all the way up here, but selling pressure pushed it down here. And which is one thing that would be good for, like, saying that, hey, prices could go higher, is that it opened above this candle and it closed above that candle. That's good. It's not retracing back into this candle. So that's a positive thing. Like we have like a low amount of volume. And what else? We look to the left. We see it's kind of been in this area before, hitting a little bit of resistance. So basically, until it until it really breaks. Look at right there too. Right, it hit this area before, and it showed some resistance here, or support here, showed support here, showed support here, kind of showed resistance right there. And depending on what side of the price action is on, it's going to be support or resistance. So the whole point is that I don't even know if it's really gonna make it up to get into this trading range of 140 to 145. If it does, and it's like 140 becomes the support and 145 becomes the resistance, then I'm probably going to be buying 100 shares somewhere in there to turn this naked call into a covered call. Well, that's needing the most attention to it at the moment. All these other ones, even though they're negative right now, they're longer term trades because they're out to like 2025. So because I'm paper trading, right? We test things out, see how it goes. I'm just letting these run. I'm gonna see what happens. If I end up losing money on these, no problem, because there were times in the first like month of putting these trades on. When did I put these trades on? I think it was October something or other. The first time I put these trades on, put these on, oh sorry, November 23rd. There were times when I could have closed out this one, this one, this one, this one, this one, all for profits. And so that's what you do. That's how you learn things in paper trading. So be it, no problem. You touch base on those. The short stock is definitely moving against me. This is really no big deal because, as I've explained before, I can't even quite remember why I just shorted one share of SPY. So I'm just letting it run just to see what happens. This is really what I want to bring your attention to end this video, as I start wrapping up this video with this. Like, I might have explained this before. I know I've explained this before, but whether or not you heard me say it, I don't know. Whether or not you know this, I don't know. Doesn't matter. I'm gonna do it again. Now with this one, right? With these two futures contracts, as I mentioned, the risk is really high, and the reward is kind of low, right? And come contract expiration date, I'm either going to make money or lose money. There's a chance I'll break even, but you know, the, usually breaking even is because you were going to lose money. And you somehow you kept yourself from losing money. But just to kind of keep things a little bit simple, think about things simply in the contextually thinking. Make money or high risk, low reward, and we're either going to make money or lose money. Same here as far as now the risk reward might not be as bad. There might be lower risk with these, but for some of them there could be some pretty high risk. You know, where I'm in this one, it's a commitment to this one is a commitment to sell 100 shares of Microsoft at $340 per share. $340 per share times 100 shares. You know, $34,000 commitment. Okay, I guess it's lower than taking on a futures contract that's equal to 1,000 barrels of oil and looking at more of $100,000. This one has a pretty big risk to it, but still, it's like, you know, in your real money trading account, how much do you have? I don't know. You know, if the most you have is like 20,000 and you're putting on $34,000 of risk, you see what I'm saying? It's a little bit like you don't even have the money to cover that. What if you got a $5,000 trading account, right? So so in a way, same thing here, where at the end of contract expiration for these, all of these, it's either make money or lose money and negative money. What am I doing here? It's either make money, right, or lose money, with a chance we might be able to break even, right? This one, make money or lose money. Now with this, what am I doing? I'm selling cash secured put options on stocks that I don't mind owning. Let's think about this for more than a second. Cal-Maine Foods, food, H&R Block, taxes. Have you heard of obsolescence risk? Obsolescence risk is the company, the product, the service might go obsolete. For example, do you remember Blockbuster Videos? That fell victim to obsolescence risk. Do you think that there'll be a technology breakthrough that'll happen that will make food obsolete? Do you think that there'll be some sort of technological breakthrough that will make taxes be obsolete? Chances are pretty low with those, right? More than likely, in 100 years from now, people are still going to be eating food, and more than likely, in 100 years from now, people are still going to be paying taxes. I get it that there's like this 1% off chance that somehow people won't be paying taxes anymore, and there's this 1% off chance that people won't be eating food anymore, but it's pretty low probability, right? There's a higher probability that Netflix will be somehow replaced with something, because Netflix kind of replaced Blockbuster, right? Blockbuster suffered from obsolescence risk and was replaced by Netflix. And it's possible that like, let's say Walmart, it's not been totally replaced, but in a way, Walmart is fighting obsolescence risk to Amazon. So do you think that it's possible that we saw Sears Roebuck? If you don't know about Sears, research it. Obsolescence risk, right? Think Apple is still going to be around? Maybe. You know, if you say that Apple is going to be around forever, then I don't think you really get it. I don't think you really get it. Now these, definitely. Anyways, we don't want to debate those. The fact is it could be true that H&R Block doesn't keep up with the times. It could be true that Cal-Maine Foods doesn't keep up with the times. But the fact is, there's a very, very high probability people are still going to be eating food and paying taxes. Whether or not they're going to be using Netflix to watch movies, something else could come out. Who knows? So to go on to the next point, right? So these companies probably going to be around, and they're probably not going to suffer from obsolescence risk. They just need to keep up with the technology in their little industry. And then from there, what is at the end of contract expiration date, what could possibly happen? There's only one of two things, right? One of two things. Before we get into those, let's talk about what it is that I'm doing here. So I have a legal binding contract that says for this one, I'm willing to buy 100 shares of Cal-Maine at $50 per share on or before expiration date of January 20th. This coming up in 3 days. That's why, well, 3 days, but I guess over here it's showing 2, 3. I guess it depends where you're counting those days at. And that's it, right? And this is cash secured because I have, where is it showing my cash? Show my cash, come on. Oh. I got the cash to do it, right? Stock buying power. Actually, if you just want a straight look at cash, it'd be right here. That's using some margin. I've got the cash to cover my promise. What's my promise here? 100 shares at $50 a share. $5,000, right? I've got the cash to cover that. Cash secured. Down here, H&R Block, what's my obligation? What's my promise? 100 shares, right? And we know it's 100 because it says here. And how many? What quantity? 1. If it said 2, it'd be 200 shares. 2 times 100. 100 shares times at $37 per share. My commitment is for $3,700 plus this $5,000. My total commitment is to purchase $8,700 worth of stock. Do I got the money to do it? Yep. Cash secured. So what happens at contract expiration date? Well, before we figure that out, let's look at this. Trade price. I got paid 30 cents and 40 cents per one contract. The multiplier is 100. So I get paid 30 bucks and 40 bucks. Contract expirations coming up. 2, 3 days, however you want to look at. 2 more trading days. And right now, this stock is trading at $38. Right now, the stock is trading at $35. The delta is 24. So it's saying basically there's about between a 24, over 24, but less than 25% chance that H&R Block's going under 37 by expiration date. For this one, there is over a 3% chance, but less than a 4% chance that Cal-Maine is going under 50 bucks by contract expiration date. So regardless, now if Cal-Maine and H&R Block stay above the strike price of 37 and 50 on contract expiration date, one thing that could happen is I make money. Right? Made 30 bucks here, made 40 bucks here. Another thing that could happen is that they could be under 50, under 34 at contract expiration date. So what happens then? I make money because I still keep that premium, and I buy income producing assets. These assets are going to make me money via dividends, and also if I want, I could sell cash, I could sell covered calls against them. But let's say, forget about the covered calls for a moment. Just look at the dividends. Now, I don't remember exactly what dividends these pay, and we could look it up. It's relatively easy to find out. But let's just keep the math really simple for a moment. Let's just pretend that they pay $1 per share per year, right? So I would have let's say I bought both of these, 100 shares here, 100 shares here. So that means I have 200 shares. It's obviously two different companies, but let's say they both pay $1 times $1 in dividend per year. At the end of the year, I made 200 bucks, right? Well, I live in the state of Hawaii. And in the state of Hawaii, we have something called a car registration. It happens every year. For me, it happens in December. My car registration is 350 bucks, roughly. Maybe it's 365, I can't quite remember. But let's just pretend it's 350. So now I've got 200 shares. I got 200 shares paying me $1 dividend per share per year, gives me $200 per year. Now let's say I end up buying 200 more shares of this. Same thing, selling cash secured put options. Right? So now I have, now I've got 400 shares. Right? 400 shares paying me $1 per share per year, gives me $400, right? So selling cash secured put options, two things happen at contract expiration date. In 2 days, one of two things will happen. One, I'm either going to make money. Two, I'm going to make money and I'm going to buy an asset that produces me money that I can acquire some more, and I can systematically pay my annual bills through acquiring assets. You get it? Do you see it? It takes some time. You got to be the tortoise. You got to go. You got to keep going. You got to be resilient. You got to keep going. You got to do some math. You got to figure out what your bills are, right? What bills do you have, right? What's an annual bill do you have? Do you live in a place where you have car registration, right? What's your car registration? If you know, let's just pretend it's $1, right? You can get a variety. Sometimes they're 60 cents, sometimes they're $1.20. You know, there's a whole range. But just keep the math easy for $1. How many shares do you need? How many shares do you need to cover that bill? You sell, well, then make sure you have enough money in your account to buy 100 shares of that stock. You sell a cash secured put option against that stock at a strike price that you can afford to buy it. That it's a good deal for you. If you want a little more help on doing that stuff, in the description of this video, there's a link to the I Have Success website. There's a playlist of trading options for beginners. Watch that stuff. That'll show you how to set up charts. That'll show you like the details, kind of more detail and theory and stuff like this. But this is the big picture to really realize. Why is selling cash secured put options on stocks that you don't mind owning so powerful, especially when they pay a dividend, is because at contract expiration for all these, you make or lose money. Maybe you break even. You make or lose money. Selling cash secured put options on income producing paper assets that you don't mind owning, one of two things is going to happen. You either make money, or you make money and you buy an asset that's going to make you more money, pay your bills. I hope you see the power of it. I hope you see that it's possible with time. Like, let's say you're in your 30s and your 40s, it's possible over the next whatever, I don't know, maybe you got $1 million laying around, maybe you got $500,000, maybe you got $100,000 laying around. You can potentially in 12 to 24 months put yourself in a position where you got a lot of annual bills covered. You just got to figure things out, work the numbers out, figure things out on your own. Hope that was helpful. Go to ihavesuccess.com, download your stuff. You guys have a fantastic day.